Greetings, everyone. I know it's a sad time. The events in Ukraine are heartbreaking, excruciatingly heartbreaking. And we're going to do our small part at ARK. Please look this weekend for a special T-shirt among our swag for Ukraine. All the profits that we make do go to charity to begin with, but in this case, we will be sending all of the profits to Ukraine. So please join us in doing your part to help them as well. On this webcast, I normally go through fiscal policy, monetary policy, economic indicators, market indicators, and then some new and interesting tidbits about innovation. And we'll do all that. But first, I'd like to focus on, this environment. As you will recall, I started doing this webcast when COVID hit, and I was on every week as the economic indicators were coming out, and we had taken a point of view that at the time COVID was a shock to the system, much like the stock market crash in '87. It was a one-day 25% crash, and then 9/11, the terrorist attack. And our point then was, after a shock, the trends that were in motion tend to come back into motion. So in the 80s, the strong stock market and the strong economy continued after the shock, after we got over the shock. And in 9/11, 2001, we were in recession before. There was the tech and telecom bust, and the shock made everything a little bit worse, a little rebound, and then back into that recession. And as you know, that was a right call for COVID. We went into a V-shaped recovery thanks to tremendous stimulus and thanks to the fact that it was a shock that was not going to be completely debilitating given the united stimulus around the world. For the past year, I feel like we've been going through a little bit of a different kind of shock, and it's associated with inflation and interest rate fears. Now, during shocks, and we saw this during COVID, what we tend to see in the public equity markets is what I call algorithms or quantitative trading strategies that just pick up on a few variables and press hard in terms of betting against them, the stocks associated with them. So during COVID, we could see very clearly that cash cushions and cash burn were the two primary variables that these algorithms seem to be seizing on. And they hurt our stocks disproportionately. In the span of 3 to 4 weeks, our stocks, many of them were down 75%, because many of our companies are earlier stage. We're the closest you'll find to a venture capital fund in the public equity markets. And of course, at that time, we said, innovation solves problems, and we have a lot of problems now. And of course, our strategies took off once the coast was clear for the markets. Well, in the last year, this fear of inflation and interest rates moving up and destroying the valuations in the marketplace have gripped the markets. And it seems as though the algorithms were focused primarily on high valuation stocks. Now, in our strategies, we own what look like very high valuation stocks in the short term, if you're only looking at this year. And I do realize that investment time horizons shrink during times of turmoil. But if you take a look at the multiples on our stocks, given a 5-year investment time horizon, you will find that they are at or below very mature innovation stocks. In other words, we've made that assumption. The valuations are going to compress dramatically to the 18, 19 times range when it comes to enterprise value to EBITDA. So we've already made the assumption that the valuations are going to come down. We believe what's happening in Russia and the Ukraine right now is turbocharging the shock to high valuation stocks that began last February when we were all getting vaccinated, and hopes were that the economy would continue to gain momentum. And so we now believe that Russia and Ukraine have turbocharged that shock and actually hopefully moved it into a period that is very cathartic and helps people understand that what's going on right now, from our point of view at least, is that the higher interest rates and higher inflation are acting like taxes on the system. And we've been talking for a while about this, about consumption slowing down dramatically. If you look at retail sales, and I'm talking about real retail sales, take out the inflation, and real consumption. We've seen a dramatic slowdown since October, and we are beginning to see inventories pile up. All of that is working out the way we expected it to. Our surprise is that many economists and strategists out there aren't putting two and two together. They're paying attention to other variables, which there is conflicting evidence, but they're paying attention to other variables that support their point of view. I'm going to go through now the policy, economic indicators, and so forth, and we'll build the case here that just like during COVID, innovation is going to solve the problems associated with supply disruptions. Here we go again, supply chain problems. This time out of Russia and Ukraine, with energy and food, some of the areas most disrupted. So these are necessities. So this is getting very serious. And we believe these are serious taxes on the consumer, especially lower income consumers, and explain why consumer sentiment has fallen apart broadly. So let's go through that right now, and we will wind up saying that because of what's going on right now, innovation is going to get another booster shot. COVID certainly accelerated many trends, and we think the higher costs associated with supply chain issues, and now even more so with Ukraine and Russia, that companies and consumers are going to turn to innovation, and that whatever our growth expectations for our companies were within the last year, they have just accelerated again, given this new crisis. So now let's turn to monetary policy. This week, Chairman Powell said, in all likelihood, the Fed would raise interest rates. He also did say, when asked the question in his testimony, that he would get aggressive if inflation seemed to be embedding into the system in a 70s-like scenario. Well, we thought about the analogy to the 70s, and we know a lot of especially old-time investors who were around during the 70s are forecasting just that, inflation embedded in the system at a much higher than expected rate. We are not expecting that. Why? It comes back to this concept of velocity, the rate at which money turns over. So I did a little more homework on velocity in the 70s. Actually, the increase in velocity started in the 60s, and in the fourth quarter from the fourth quarter of 64 to the first quarter of 81, velocity increased 21%. so the rate at which money turns over in the economy. And what that meant at that time, at least, is many people used to buy, as soon as they got more income, they would buy goods and services, and especially goods, right away, as quickly as possible, because they were afraid prices would go up or interest rates, in the case of cars and other durable goods, would go up. So buy now before prices and interest rates go up. And that became a self-fulfilling prophecy. If you look at what has happened since 1997, and I was actually surprised to see the peak in velocity this time around that long ago, from the third quarter of 97 to the fourth quarter of 2021, velocity has dropped 50%. Now, what we've seen is a couple of things. We saw two crises, tech and telecom bust, 08-09 financial meltdown, a lot of fear, and inflation and interest rates continuing to trend down. And so this thought that we'd have to run out before interest rates and prices went up, we didn't have to worry about that much anymore. Some people are worrying about it today, to be sure, but even so, in the last 12 to 18 months, velocity has been flat. It has not gone up. And consumer sentiment would suggest that the next leg in velocity will be down. On top of that, money growth rates have decelerated from the high at 27% in 2020 to 12.6%. That's the January reading. But if you look at money growth on an annualized basis, it is slowing down. It has slowed down in the last 3 months to the low single-digit range. So already we think there's a dramatic deceleration in money growth underway that many people are not focusing on. Fiscal policy, we're in gridlock. We're in a midterm election year. But we know that we are also on the other side of the stimulus payments associated specifically with the coronavirus crisis. As a result, federal outlays are falling on a year-over-year basis. That is also a break on the economy. On to economic statistics. Today was Employment Friday. That's why I'm doing this today. And the report was very strong, very, very strong. And in fact, we had non-farm payrolls up 678,000. Expectation was 481,000. And the household employment survey was also strong at over 500,000 as well. One of the things that we are wondering about now is seasonal factors. Because of COVID, we've had a shift in seasonal factors. We had Omicron hit late last year. And so we don't know if the seasonal factors are exaggerating what's going on right now or not. We also do believe that given the labor shortages that have been widely reported around this country, but in other countries as well, we wonder if companies, once people do apply for jobs, are saying, okay, finally, I better hire this person, even though my business is slowing down a bit. I don't think it's going to contract, and I really need to fill this position. Some of that could be going on. So the unemployment rate is now 3.8%, which is near the low point pre-COVID. So that's very good. The work week went up a bit, which is always good. That's actually turbocharges those employment statistics. But the previous month was revised down a bit, so about even there. Labor force participation rate went up. That's been a big question. Will labor supply start picking up now that the COVID coronavirus has passed, hopefully? That will alleviate wage pressures, of course. Now, the shocker in the report was wages, but not on the high side of expectations, which is what everyone was expecting and which has been happening. maybe the supply increases are already at work because the average hourly earnings index was flat. Now, on a year-over-year basis, it's up 5.1%. So that was very interesting and probably my biggest takeaway in the report. One of the things that we believe is that this employment report is old news, and employment actually is a lagging indicator. It contains a lot of information about what's going on what has gone on in the economy. But one of the metrics we keep our eye on is energy consumption as a share of GDP. And that is reaching a high that we have not seen since 08-09. And every time it has reached that level, it's again this question of purchasing power and consumer sentiment. Every time it has reached that level, we have gone into recession. I noticed today the White House is proposing a ban on Russian imports. I think that Russian imports account for roughly 3% of our energy imports. So that's not devastating, but it will cause again more problems, and it is why one of the reasons prices are going up. Consumer sentiment continues to plummet, and we look at the indicator or the index within the University of Michigan Consumer Sentiment Index. Good time to buy a car. That's one of the most cyclical sectors out there, and it continues to fall. Now, in January, auto sales did pick up. They picked up from roughly 12.4, I think it was, to 15. And we think that was a gusher associated with the auto companies finally getting chips to put in the cars that were waiting for the customers. We got another report this week. Auto sales were down again, so from 15 to 14.07. So we don't think that hopes of the auto sector moving back into a V-shaped recovery are going to play out at all. We also know, as I mentioned before, that real retail sales and real consumption, if you average out the fluctuations over the last 3 months, look pretty flat, if not slightly down. Meanwhile, inventories are picking up at a pretty rapid rate. Inventory to sales ratios, many people point out, are very low. But if consumption stops, inventories can build very quickly. And then our supply chain problems will go away. Not the best way for that to happen, but it is true. Housing still remains strong. Again, a lot in the pipeline. A lot of people have been waiting for that house. So it could be a little bit of a lagging indicator. Capital spending is strong. We think that's a necessity as the globe digitizes much faster than might otherwise have been the case. I mentioned government outlays down. That's a brake on the economy. And in terms of trade, we have no idea what's going to go on. I think our imports will continue to grow very strongly because the orders were placed a while ago, and I think that will become part of the inventory problem. The one good news on inflation, and we don't have much, the commodity complex is on fire. But one piece of good news is the productivity numbers we got in the last few weeks were very, very strong. Now, it's been very volatile recently, but at least for the last quarter, productivity growth up 6.6%. And that took unit labor costs down to only a 0.9% increase. So compensation, yes, rising very rapidly. Productivity rising very rapidly. And productivity, I have to say, or have to emphasize, is very much a function of innovation taking place. So that's consistent with what we think is going on, that innovation is accelerating. Now, onto the markets. I'll give you the top and bottom sectors, at least for the S&P 500, over, year to date. And no surprise, given what has happened to the energy price, Energy is the only sector that's up. It's up 33%. And consumer staples and utilities are the fill out the top three. They're down just a bit. So that's an interesting combination. Energy, we know what's going on there. Staples is a very defensive sector. That says that investors are becoming somewhat concerned about the economy. And utilities are interest rate sensitive. So when interest rates go down, utilities dividend yields look better and better, so they tend to outperform. Now, in a rising inflation environment, interest rates are not supposed to come down. And at the short end of the curve, they are not coming down, but at the long end, they are, and we'll get into that in a bit. The worst performing sectors are associated with the consumer. Again, I think the loss of purchasing power is a big problem for the consumer. So consumer discretionary, consumer services, and technology, which despite innovation getting a booster shot from problems, as innovation solves problems, it is a high beta sector. And so many investors just shy away from it when trouble seems to be on the horizon. As far as the bond market, the long Treasury bond yield peaked in mid-February at 2.06 and is back down to 173. Now, what's been very interesting is the yield curve, which peaked in March of last year at, I think, roughly 160 basis points. So the difference between long-term interest rates and short-term interest rates, 160 basis points. And that was a reflection of easy monetary policy, short rates being much lower than long rates. Now that the fear is that the Fed is going to increase a number of times, we're seeing short-term interest rates up a lot, certainly in the context of recent history. But long rates not going up as much. And so the yield curve has compressed to 25 basis points. Now, we're getting close to an inverted yield curve, meaning long rates below short rates. And that is often a sign that the Fed is too tight and real growth is going to disappoint and inflation is going to be lower than expected. We think that is the case, and we've thought so for some time. High yield spreads, so the difference between high yield bonds, interest rates, and Treasury bond yields, they are moving up and corroborating that outlook. Now, they haven't spiked, and it doesn't suggest duress out there yet. But they're not much above pre-COVID levels, indeed. But if they move up rapidly from here, we will be in a territory that would suggest that some companies are finding it difficult to service their debt. In other words, their business is falling off. Commodities, they're on fire. We believe this is a supply problem, much more than a demand problem. I'm sure there's a scramble to build inventories of anything now, anything in the energy complex, any of the metals that come out of Russia, food out of the breadbasket of the Ukraine. Interestingly, the commodity price increases are in the face of the dollar increasing. The dollar increasing tends to put pressure on prices, but this supply problem and maybe inventory hoarding is overcoming that. The dollar is going up because it's a flight to safety currency, and we're also seeing other flights to safety. So the dollar's up about 2.5% since the end of January, when the Russia-Ukraine issues were becoming more obvious. And then the other two flights to safety we've seen, Bitcoin 6.1% and gold 8.3%. So those are the markets. Now on to innovation solves problems. Our analysts have been providing me with a running list. Here are some of them. So The crypto networks are proving their worth as a neutral technology platform. We're seeing donations of both Bitcoin and Ether to the Ukraine. I think it's 50 million, if I'm not mistaken, in the last week. And we're also seeing Bitcoin as a currency hedge for Russian citizens who are watching the ruble get hammered here. And, you know, these are not the oligarchs. In fact, as we were discussing at our brainstorm today, there's not enough Bitcoin out there for the oligarchs to hedge. And they have been hedging for years anyway. This is for the average Russian citizen who actually is aghast, many of them, as we hear it, aghast at what's going on in Russia. Tesla is providing free supercharging in Poland. Poland's taking in, of course, a lot of refugees. And of course, we know that longer term, electric vehicles are going to help with the demand destruction of oil. I think the prices alone will destroy a lot of demand for oil and accelerate the shift to electric vehicles. And especially, we believe robo-taxis will be electric, and they'll be on the road 50 to 60% of the day. So that acceleration away from oil will happen as we move into the autonomous realm. We're seeing a lot of talk about renewables, especially nuclear, to reduce dependence on Russia. Of course, solar and wind, but I think nuclear is becoming less of a negative, even to some environmentalists who have studied it a little bit more carefully. We're seeing, of course, the social platforms providing real-time updates and providing, you know, a glimpse into the horrors that are taking place there. And I think that has put a lot of pressure on financial institutions and others to boycott or stop doing business with Russia. It's terrible for the Russian citizens who do not want this invasion. But I think we've never seen the financial system used as such a weapon. And we'll see if it works. We also know about Starlink. I think the president of Ukraine reached out to Elon Musk and say, "Hey, we're being cut off out there." And of course, Elon sent Starlink to the rescue. So that's phenomenal. That's phenomenal that we can continue to communicate with these people. And again, everyone around the world can see the horror that Ukraine is experiencing. So those are a few. I mean, there are many other on the medical front. There's a company called Butterfly, which has sent hundreds, if not thousands, of point-of-care ultrasounds for medical triage and emergency response. And there's a company called 908 Devices, which is the only mobile mass spec machine broadly that enables in-the-field detection of hazards, bioweapons, pollutants, and contaminants. So a lot of our companies are doing what they can to help the cause. While the public markets don't appreciate what's going on in the innovation world, in fact, quite the opposite. They have taken a sledgehammer to these stocks in the last year. The private markets certainly appreciate what innovation can do and will do to help solve the problems that have arisen from the coronavirus crisis, the supply chain problems, now Russia and the Ukraine. According to a study that Max Friedrich, one of our fintech analysts, has done using Crunchbase, the Crunchbase database, it looks like while innovation stocks in the public markets have dropped. Certainly pure play innovation, those that are not in the indexes. Those in the indexes are the innovation stocks in the indexes tend to be a little more old world. We even see from Meta platforms, formerly Facebook, that the once disruptor is being disrupted. But if you look at the non-benchmark innovation stocks, you'll see that they're down 60, 70%. So it's a replay of the COVID crisis. And as we said back then, innovation solves problems. And I'll say it again because it is true. What we're seeing the private world do is actually move into up rounds over the last 20 years. The last year, the average up round has been 20%. So down 60% in the public markets, up 20% in the private markets. And we think the private markets have gotten the plot and corroborate our point of view. And truth will win out, just like this idea that innovation solves problems was a winning strategy coming out of the coronavirus. We believe it will be ever more so as our 5 platforms, DNA sequencing, adaptive robotics, energy storage, artificial intelligence, and blockchain technology all scale exponentially during the next 5 to 10 years. And we're seeing evidence that these superior growth rates will power through any recession, and that innovation-oriented stocks are going to, and from a relative point of view, look much, much better from a relative growth point of view than anything you'll find, certainly in the value space, but even in the more traditional growth space. So with that, I guess I'll close saying that our hearts are heavy for the Ukraine. Our prayers are with the people of the Ukraine and for the people in Russia who want nothing to do with this. And I will then come back to you next month, and hopefully we will see a lot of resolutions. Thank you very much.